Good morning. As the sun rises over the world's financial capitals, millions of people are already at work, making decisions that ripple across the globe. We hear about the stock market's daily swings, the flashing numbers and frantic trading, but the real engine of global finance is something quieter and far more fundamental: the government bond market. A government bond is essentially a loan to a country. When you buy one, you're lending money to help fund everything from new highways and schools to social programs and pensions for retirees. These bonds are the backbone of public spending, quietly supporting the services and infrastructure we all rely on. Investors trust these bonds because governments, especially those seen as stable and reliable, are expected to always pay back what they owe. This trust is the foundation of the entire financial system, allowing countries to borrow at reasonable rates and investors to sleep soundly at night. The interest rate or yield on these bonds doesn't just affect governments. It sets the tone for borrowing costs everywhere, from the rates on your mortgage and car loan to the interest you pay on credit cards and business loans. When yields move, the effects ripple through every corner of the economy. When yields are low and steady, the world economy hums along, businesses invest, and families plan for the future. But a sudden spike in yields can shake the entire system, making borrowing more expensive and triggering panic among investors and policymakers alike. Japan, the world's third-largest economy, has long been a pillar of this market. With over $9 trillion in government bonds outstanding, Japan's financial stability is crucial, not just for its own citizens, but for investors and governments worldwide. For decades, Japanese government bonds have been ultra-stable, thanks to a unique mix of low inflation, low interest rates, and a culture of saving. Sometimes, yields have even dipped below zero, making them a safe haven in turbulent times. But this remarkable stability is built on a mountain of debt. Japan's government owes more, relative to the size of its economy, than any other major nation. This massive debt load has always been a concern lurking in the background. In January 2026, a crack appeared in this foundation. Suddenly, investors began to worry that even Japan's government bonds might not be as safe as they once believed, sending shockwaves through global finance. What happens when the world's safest investment suddenly looks risky? That's the question now facing investors, governments, and ordinary people everywhere. A crisis in Japan's bond market has put the entire global system on edge, raising fears of contagion and uncertainty about the future. In the next few minutes, let's break down what happened, why it matters, and most importantly, what it could mean for your financial future, no matter where you live. The crisis erupted on a seemingly ordinary Tuesday in Tokyo, as the city bustled with its usual energy. Commuters hurried to work, unaware that the day would soon take a dramatic turn. At 9:47 a.m., Prime Minister Sanae Takaichi stunned the nation by announcing a massive new spending plan and calling a snap election, hoping to rally support for her government's bold move. But instead of inspiring confidence, the announcement sent shockwaves through the financial world, triggering immediate panic about Japan's already enormous debt burden. Investors quickly realized that more government spending would mean even more borrowing, and with it, a surge in financial risk that could no longer be ignored. Within minutes, yields on Japan's 40-year government bond soared to levels not seen in decades, a clear signal that fear was gripping the markets. Trading was halted 3 times in under an hour, as officials scrambled to prevent a full-scale market meltdown and restore some sense of order. By day's end, the 40-year yield had jumped to 4.24%, a staggering move that would normally take months, not hours, to unfold. The dam of financial stability had broken, unleashing uncertainty and fear across the markets. As Tokyo's markets closed, the shockwave didn't stop. It rolled westward, racing across time zones and continents. U.S. Treasury yields spiked as the American market opened, with traders scrambling to adjust, followed by similar jumps in Europe as the news spread. German, French, and Italian bond yields all surged, reflecting a growing sense of alarm throughout the global financial system. The message was clear: this was no longer just Japan's problem. The world was now on high alert. The crisis had gone global, dominating headlines and sparking urgent meetings in financial capitals everywhere. And it was moving fast, with markets and governments scrambling to keep up as the world watched, uncertain of what would come next. Japan now faces an impossible choice, one that will define its economic future for years to come. With investors demanding higher yields and global markets on edge, the Bank of Japan must act decisively. But every available option comes with its own set of painful consequences. Option 1: raise interest rates to defend the yen and stabilize government bonds, hoping to restore confidence in Japan's financial system. But this could trigger a deep recession, widespread job losses, and force the government to slash spending on essentials like healthcare, pensions, and education. Everyday life for millions could be upended. Option 2: print more money to buy government bonds, keeping yields down and trying to avoid a market panic. But this would crash the yen's value, unleashing a wave of inflation that erodes savings, raises the cost of imports, and makes daily necessities more expensive for everyone. There's no easy way out, just different kinds of pain, each with its own risks and uncertainties. Japan's debt is now so massive that no outside bailout is possible. The country must face this crisis alone, with the world watching closely. The world is watching as Japan's central bank prepares to make its historic decision at the end of January, a moment that could reshape the global economy. The consequences will ripple far beyond Japan's borders, affecting markets, currencies, and economies everywhere. The stakes couldn't be higher. Every decision will be scrutinized by investors, governments, and ordinary people around the globe. The next move will shape not just Japan's destiny, but the future of global finance for years to come. This crisis isn't new. History is full of similar financial disasters. In 1992, the UK tried to defend its currency by hiking interest rates. It failed, the pound crashed, and recession followed. In 1997, Asian economies printed money to defend their currencies. The result? Currency collapses, hyperinflation, and social unrest. Greece, during the European debt crisis, tried both austerity and money printing. The result was a lost decade and soaring unemployment. These stories show that when debt becomes unmanageable, there are no good choices. Raising rates can trigger recession and unemployment. Printing money can destroy savings and spark inflation. The pain is real, and the fallout can last for years. Japan's situation is bigger and more complex than any before. The world is hoping history doesn't repeat itself. But the warning signs are clear. The stakes are global. How does a crisis in Japan threaten the world? The answer: capital repatriation. For years, Japanese investors bought trillions in foreign bonds, keeping global interest rates low. Now, with Japanese bond yields surging, they're selling foreign assets and bringing money home. This isn't a choice. It's a necessity. The first domino, the U.S. Treasury market, where Japanese investors are the largest foreign holders. As they sell, U.S. bond prices fall and yields rise. The same happens in Europe. German, French, and Italian bonds are dumped, pushing up yields. Emerging markets get hit too, as the carry trade unwinds and their currencies tumble. What started as a political move in Tokyo is now a global financial cascade. The world's financial plumbing is under stress. The effects are everywhere. The U.S. is especially exposed to Japan's crisis. For years, Japan was a reliable buyer of U.S. government debt, helping keep American borrowing costs low. Now, Japan is a forced seller, and U.S. borrowing costs are rising. Even a small increase in interest rates adds billions to the U.S. government's annual expenses, straining the budget. Higher Treasury yields mean higher mortgage, car loan, and credit card rates for Americans. Businesses face higher borrowing costs, which can slow hiring and investment. As yields rise, markets may question America's own debt sustainability, creating a dangerous feedback loop. The U.S. is losing its biggest foreign creditor at a precarious time. The shockwave from Tokyo is now America's problem. The risk to U.S. economic stability is real. Europe is next in the path of this financial storm. Japanese investors were major buyers of European bonds. Now, their retreat is driving up borrowing costs across the continent. Countries like Italy and France, already burdened by debt, are especially vulnerable. The European Central Bank's efforts to keep rates low are being overwhelmed. Memories of the 2012 Eurozone crisis are resurfacing, as fears of default and political instability grow. The UK, still reeling from past financial shocks, is also at risk. Europe and the UK are now on the front lines of a crisis they didn't start, and can't escape. The financial contagion is truly global. This isn't just a story about markets, it's about your money. Higher government bond yields mean higher rates for mortgages, car loans, and credit cards. Companies may cut jobs or delay hiring as borrowing gets more expensive. Retirement accounts invested in bonds could lose value as prices fall. A bond market crash shakes the foundation of what's considered safe. The global economy could slow, making jobs and savings less secure. A decision in Tokyo can affect your mortgage in Ohio or your pension in London. Understanding these risks is the first step to protecting your financial future. As of February 4, 2026, the world is watching Japan. The Bank of Japan's policy meeting on January 31st is the first key moment. Will they raise rates or print money? The snap election on February 8th adds more uncertainty. A major bond auction on February 15th will test investor confidence. What started in Japan is now a test of the entire global financial system. The next moves will shape the world's economic future. Stay informed. The aftershocks may be even bigger than the initial quake.